The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe, and just telling you, we've got some data heading the wires as well, with UK average earnings up 3.5%, unemployment up 83,000 in the UK. Welcome to Squawk Box with Karen Cho, myself, Steve Sedgwick, and Ben Boulos as well. Morning, Ben. These are your headlines. President Trump threatens to bomb Oman. Wow. If it gets in the way of efforts to reopen the strait after the Iran MOU expires with no signs of diplomacy ahead.
Fading hopes of a peace deal sees Brent climb above $90 a barrel, while equities and bonds pull back. The bond sell-off pushing the 30-year Treasury yield to its highest level since 2007.
The ECB warns of a likely correction in US big tech stocks, writing that the region's households, insurers and pension funds all have significant exposure to a potential pullback.
Right, I'll just run through those numbers again. Good morning, everybody. 4.9% in the 3 months through June is the latest ILO. That's the International Labour Organization measure, by the way. There are various measures. That is the latest measure on UK employment / unemployment. The employment, though, up 83,000 in the 3 months to June. That is versus a poll of 129,000. So underwhelming there. And the data on that 4.9% figure, by the way, higher than the 4.8% expected. Average weekly earnings up 4.1% year on year. That's pretty much in line with the 4% expected. Karen.
Let's push on to the headline news. And US President Donald Trump has threatened to bomb Oman, an ally of Washington, if the Gulf nation, quote, gets in the way of US efforts to reopen the Strait of Hormuz. This as a 60-day memorandum of understanding between the US and Iran expires, with no signs of official negotiations or a deal to end the almost 6-month-long conflict. In the past few hours, a vessel has reportedly been struck by an unknown projectile whilst transiting the Strait of Hormuz, according to the UK Maritime Trade Operations, causing a crew casualty. Let's get out to Dan for more. Dan, the markets in recent days have been very closely eyeing the situation. We've seen some heat in that oil price. Just to walk us through where we stand, particularly now around these threats against Oman.
Karen, good morning. Well, President Trump ruling out an extension of the US-Iran truce as this 60-day MOU expires with no new deal in place. And as you just reported, the president also sharply escalating the rhetoric towards Oman, a longtime US partner and also a traditional mediator with Tehran, threatening to bomb the country if it, quote, gets in the way. Now, that is an extraordinary threat because Oman is not just not a US adversary. It's also a long-standing American security partner that gives US forces access to key ports in the region and has for years really served as one of Washington's most important back channels to Iran itself. The former US ambassador to Oman, Mark Sievers, joined me on Access Middle East this morning. Here's how he responded to the president's threat.
It's not the first time that the president has suggested that he might bomb Oman. I think it is trying to get their attention more than a practical threat. Clearly, there is frustration in the White House that Oman seems to be partnering closely with the Iranians on developing a channel for the Strait of Hormuz. We don't know what the details are yet that'll come out. Earlier, a few weeks back, the Omanis had suggested a neutral channel in the middle of the strait that would not be under the control of either side, but the Iranians rejected that. So I don't really know what the substance is at the moment, but I think it appears that the U.S. side wants the Omanis to leave it alone and let the U.S. take the lead in opening the strait.
Ambassador Sievers there on CNBC responding to this extraordinary comment from the US president overnight. In that interview, he also told CNBC that since the beginning of this conflict, he said Oman has gone from being a neutral mediator to a partner with Iran in trying to come up with a solution that's acceptable to the Iranians. In the process, he says, they have lost the support of the United States. So the immediate risk right now, at least for traders, is once again the Strait of Hormuz. We know shipping has slowed dramatically. Iran is continuing to try and separate these talks with Oman over reopening the waterway. Iran saying the two sides have already agreed on what is a basic map of a transit route, potentially sending inbound ships closer to Iran and outbound ships closer to Oman. Of course, the problem for Washington and what appears to have gotten under the president's skin overnight is that any arrangement here could effectively give Iran a formal role in controlling access to Hormuz, which, of course, this president so desperately wants to avoid. It's back over to you.
Dan, I've just gone onto the internet, and there is something called RAFO thumb rate, which is a base operated by the Royal Air Force of the UK, but actually is a home to a US Air Force presence as well. Look, it seems inconceivable that the US would bomb Oman, and the message that would send out to the GCC, other allies, if they weren't to do the US's bidding, would be quite extraordinary and unprecedented as well. Adding these comments to previous comments of the weekend that the US might take over the Strait of Hormuz as a sovereign territory, is the US getting desperate here and just saying more and more outrageous things to try and get some form of reaction? I can't think why the US would be saying this, and I don't think the US would ever do this, I'm pretty sure. But who knows in this situation? How desperate is the US to end this conflict?
Right. Well, the origin of these threats, the intent and the strategy, all very unclear at this point, Steve. And you also get the sense that a lot of this commentary is really wearing thin among the Gulf and Arab leaders here who are still grappling with a conflict that is ongoing. And of course, in the region right now, no war, but also no peace. And so the pathway forward here looks increasingly uncertain. What the United States is trying to achieve by leveling these threats towards its own allies is really unclear. And whether this was just an off-the-cuff comment, maybe the president responding to an emotion in anger to a situation that he perhaps perceives to be out of his control, or whether this was a genuine maybe intent to signal that the United States is desperately disappointed with Oman and does in fact intend on going ahead with some kind of military action remains unclear. I think the latter seems very unlikely at this point. But of course, this is just another page in what has been a long-running saga. I asked the former ambassador this morning whether he thought the Iran war had been mishandled by the president and by the United States. And there is also a view forming in the region that he shared that perhaps that is the case at this point. So look, which way this goes from here is anyone's guess at this point. The president's still controlling the narrative and everyone else watching and waiting to see exactly what happens.
And I just want to clarify, it's the Royal Air Force of Oman that I should have said operates it, but the Royal Air Force of Britain do use the base as well occasionally, sporadically as well. So the RAFO is the Royal Air Force of Oman. Thank you.
Meantime, elsewhere in the region, US President Donald Trump's son-in-law and envoy Jared Kushner has wrapped up 2 days of talks with top officials from both Israel and Hamas without a major breakthrough surrounding the US leader's Gaza peace plan. Ben.
So let's check in on how equity markets are looking. And we have seen the oil price rise for a third consecutive day. Brent crude now above $90 a barrel. That is having the effect of weighing on equities. The three benchmarks on Wall Street closing the first day of the week lower. It's the Dow and the S&P both off around 0.5%. The Nasdaq slightly thinner losses, but still decisively down around 0.33%. We saw the Treasury yields climbing as well. That also weighing on equities. We'll dive into that in more detail in a moment. But let's turn our attention to the Asian markets. After what had been a fairly strong start to the session on some of the indices, the Kospi in particular, they've all gone into reverse gear as the session has progressed. The Kospi off by 2.4%. The Nikkei down as well. We've seen the yen weaken once again against the dollar. It's given up about half of the gains it made following the joint intervention between the US and Japan to prop up the Japanese currency. The Hang Seng and the Shanghai Composite both below the flat line as well this morning. What are we expecting when European trading gets started within, under an hour from now? A mixed picture being called by the futures. It's just the FTSE on this wall that is being anticipated to open higher, but only by the thinnest of margins. The blue chip Pan-European Stocks 50 off by around 0.5%, and the DAX futures off by 0.4% as well. We'll keep tracking that as we approach the open. Tell you what else we'll keep tracking is the US futures, because we saw a day in which the benchmarks on Wall Street all closed, as I say, Monday lower, looking to extend those losses once Tuesday trading gets started. So we'll keep track of that and bring you updates throughout the show. Steve.
All right, just a quick whiz through the treasuries in the United States as well. Here you go, the 10-year paper trading at 4.74. The 30-year, where, again, we haven't had a guest on this show for a long, long time who said, I like the long end. I like the long end. They keep saying, look at the bang for the buck you get on the short end. You get 4.2% with relatively lower risk is what the message we seem to be getting on a regular basis. But the long end now trading at multi-decade highs on both the auction last week and indeed in the physical now at 5.33%. Let's have a look at global yields as well, and where we're trading on the UK 10-year paper after employment data, 5.08%, and the German benchmark trading at 3.22. So Brent is trading around $90 mark. Equities are coming off their highs. The yield on the 30-year Treasury, as we just mentioned, just hit its highest in nearly 2 decades. And yet the VIX just hit its lowest level this year, moving some analysts to warn of investor complacency. Jonathan Krinsky at BTIG warning that we are in a window that historically sees downside volatility. And that's with markets at an all-time high ahead of midterm elections. Let's get to Ron William, who is the founder and principal market strategist at RW Market Advisory. Ron, is the market at a top, or is it going to carry on from here, according to your research?
Well, tactically, our current macro theme is still shaken, not yet stirred. So we are looking for the bearish side. But markets, as we've all seen, have recovered strongly from various headwinds. Tactically, to your question, 3 key factors weigh: sentiment overstretched, rotation fragility, all amplified by a Q3 higher risk timing window. So all of this points to greater volatility and a counter rotation between greed and fear assets.
Sorry, I'm confused. What does that mean? Does that mean we're going down or up?
So on the S&P 500, if we have the chart at hand, watch price markers back under the former range of 7,600, 7,300. So that would be the downside skew. But ultimately, the risk is a healthy shakeout of 10 to 20%, which is our base case, back to pre-geopolitical shock levels of the March lows.
So just to clarify, because I am, as you know, incompetent when it comes to reading technical analysis, we're going down by 10 to 20% is your call in the third quarter?
That is the base case scenario here at RW Advisory, yes.
Ron, can I just take the other side of this? We had a very strong earnings season. We're seeing some market breadth come in, not just around big tech names, but other areas of, say, the S&P 500 have also lifted. What do you make of that breadth coming to markets? Does that not count when it comes to technical analysis?
Breadth is the lifeblood of the market, and certainly a healthy thing to see in normal business cycles. But according to our big picture macro cycle work, we are a late stage cycle, and this is further fragility underneath the surface in terms of the rotation itself. So yes, it is the broader equity market trade. You can see equal weighted indices outperforming the actual benchmark Wall Street indexes, but we do see that as fragile here and now, particularly with overstretched momentum, sentiment, as well as our Q3 risk window. I might add that's negative seasonality from late August into November, as well as midterms, what is deemed as the lame duck effect for second-term presidents, particularly when polls are down and confidence ultimately continues to be under pressure.
There's been a lot in recent days about counting down to the midterms and even some of the polling too for Trump. But I want to get to the oil price because there's a lot of foreign policy in the mix, closely watching the events out of the Middle East. And some of the fragility in markets, one could argue, is also stemming from the Middle East situation. I mean, the Dow was on a very strong run until we had some negative news flow, and that really took the shine off the Dow. So when you look at the oil price, what do you see in terms of the move higher?
Well, this is what we deem as the greed and fear rotation between greed equities and fear oil, case in point, as part of that inflation, but also geopolitical scare, which is now being revived. Watch the headlines that we've just been reading out just now. And certainly at the heart of that, renewed energy volatility, which is now snapped back higher from oversold conditions in line with the renewal of hostilities. That is reigniting inflation pressures. Our base case since the start of this year is, a revival of macro volatility, but that underpinned by a broader commodity supercycle strength, which we can discuss in a moment, with oil at the heart of that. So we're looking for further upside with potential spike risk still at play on oil. A long-term chart of oil going back to the 70s shows that spikes not only typically happen, but they behave in a two-stage shock fashion. 1970s is a case in point, 73 and then 79, where ultimately the second and final shock is the one that leads to systemic risk. So keep all of that in mind. And then just lastly, in terms of price levels, spikes can extend into $150, $200 as part of an escalation risk. And in real terms, we've seen that, i.e. inflation adjusted, on oil in past crisis times.
Yeah, Ron, commodities, anyone investing in commodities may have concluded they've had enough of the whiplash that we've seen with the fluctuation in prices this year since the Iran war began, and they may be looking at other commodities. Where does oil sit relative to other commodities in terms of attractiveness, in your view?
Well, certainly as part of a broad supercycle commodity rotation, which has already been in play, it's proven itself time and time again over the last year or so across gold in terms of monetary stress, energy in terms of supply side disruption, but soon ahead, agriculture in terms of the secondary effects of consumer inflation, but also some other supply side constraints. So that's the commodity broad rotation. But if we look at commodity as part of a super cycle and compare the ratio of commodities versus S&P 500, that cross asset capital flow rotation is now in a once in a lifetime generational rotation where fair value, and this is the big headline, is a 4-to-1 relative outperformance. And this is something that although it's a clearly big opportunity ahead, it is still very understated in terms of portfolio allocation and market consensus. So our highest conviction commodity themes remain each of the commodity subsectors just mentioned. And the macro themes are very much inflation, volatility, supply side constraints, and a weaker dollar.
Okay. Just finally, Ron, we saw people pile into the dollar after the Iran war began, seen as a safe haven currency. What's the current status? What's the situation with the dollar as we speak this morning?
Short term, the dollar is already breaking down, looking at the dollar index as from a technical perspective, but it's also unwinding from overcrowded decade long extremes. That's now transpired in the major currencies, but also more specifically Asia, yen intervention as a case example. But we can see on the dollar index a short-term breakdown in terms of trend and positioning. And certainly this is part of a medium to long-term view of diversification out of the US, both in terms of currency and equities, as we continue to complete this late-stage cycle.
OK, Ron, thank you very much for joining us. Ron William, founder and principal market strategist at RW Market Advisory. Still to come on the show this morning, the ECB weighs in on the risk of correction in US tech stocks. We will discuss. Plus, the squeeze in copper market intensifies amid potential US tariffs. And we'll be pulling on our football boots to discuss Maradona economics with Nomura's chief economist, George Buckley. That'll kick off at 8:30 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions. And I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. Welcome back. CNBC has confirmed Anthropic's annualized revenue run rate to hit $65 billion at the end of July, around a seven-fold increase from a year ago. This as the Claude maker gets geared up for what is said to be a blockbuster IPO. Nvidia, meanwhile, is set to provide up to $105 billion in financing for a new OpenAI data center in Ohio, according to securities filing. Why is Nvidia providing the financing and not financiers? Just asking for a friend. Anyway, in the chip giant's latest deal to support the AI data center build-out. The credit will support an initial 4.25 gigawatts of computing capacity, with Nvidia providing the compute.
Meanwhile, a team of economists at the European Central Bank have warned a correction is likely in US tech stocks amid what they call extremely optimistic valuations, even arguing a sell-off is coming even if current valuations are rational. That correction could threaten euro area financial stability, with researchers warning that unlike when the dot-com bubble popped, there's less room today to cut rates or try and grapple with the fallout fiscally. Well, it is a steady string of central bank warnings we've had recently. Jeff Schmidt over at the Federal Reserve the other week warning whether tech now could be too big to fail. These warnings from the Eurozone, somewhat concerning given we think about the build-out in Silicon Valley, build-out across infrastructure, having such a big consequence for financial market stability in the Eurozone, such a particular part of the economic environment, the fragment of Europe. The pullback for me, what was concerning here was about the valuation argument, because we've heard from a lot of fund managers saying, look, some of these stocks not overvalued. The Crosby, for instance, you look at this SK Hynix and Samsung, that has been one of the big arguments based on earnings. These are not overvalued stocks. And the point that was made by the ECB was that you don't have to have super valuations on some of these stocks. You could still get a correction here and would have consequences. So if you think you're protected because of the valuation argument, that is not what the ECB is saying.
Yeah, I'll tell you, when I hear that ECB warning, what's ringing in my ears is the conversation I had with Nicolai Tangen, in charge of the world's largest sovereign wealth fund, Norway's oil and gas fund. And I said to him, are you not worried that given a lot of the returns the fund has made, the record returns are concentrated in tech and AI and that trade, that if things did turn lower and there was a correction, that the fund would lose money? And he said, but that is the nature of investing. You have to ride out the dips as well as the rises, because if you try and time the market, that's when you make mistakes, and that's when it's much harder to get it right. And actually, if you are invested, you've got to accept that at times you will see some losses.
Yeah, look, all of this is common sense. It's absolutely right that the ECB is putting it out there as a risk. It's just like the BIS did before 2007's market event as well, just like I would have liked the credit rating agencies should have warned in 1999, but didn't as well. So it's then possible, once people have all the information before them, to either buy, sell or hold the market. I've just had an interesting email. I'm chatting to Ronan. Good morning, Ronan. I'll send you an email now saying, shouldn't you be impartial? You're obviously a big bear on the market. Absolutely not, Ronan. I'm completely not. I'm agnostic, but I would challenge any bear as robustly as I challenge a bull, and vice versa, I think. I think that's what I try and do as well. But I think it's great that the ECB is pointing out the risks, and then everyone with full information can make their own investment decision.
To me, the commentary is very similar to what we're hearing in other quarters, where we all see that this is breakthrough technology. The question is how you get from A to B, and whether it's a very rocky path to get there, the disruption it brings, whether there could be a severe correction in price action, whether there could be a problem in rolling out some of this incredible technology, whether you hit bottlenecks, whether the one of the partners in the mix encounters an issue. And obviously, when you think about the partners, they're all interconnected. You know, OpenAI was the one that was leading the charge. No longer, you've got Anthropic at the forefront, but still very entwined in the entire mix. So if one of these particular names were to fail, which was, I think, the point that Jeff Schmidt was making the other day, what would it do to the rest of those in the ecosystem? Everybody's on the hook effectively. And then if you've got a lot of investment that is made by a lot of people on even this side of the world, it has consequences then for stability in Europe, but also for the growth story in Europe. So the warnings are pretty stark.
Yeah, and look, any student of history of any large capex cycle going back 300-400 years will know that it always ends the same way. There is always a rush of overinvestment into these cycles. Now, whether that results in a market crash or not, that remains to be seen, and that is something I'm absolutely not calling. All I'm saying is that the capex cycles, whether you study the 1870s or 1860s, 1870s railway boom, whether you look at various instances in the East India Company back in the day, or tulips, or the South Sea bubble, or whatever it may well be, let alone the 20th century, 1929, and et cetera, it always ends the same way. The over-investment in capex always has a retrenchment thereafter. But
the problem with this, and you pay homage to history and you want to be prudent with your investments, and you think, well, maybe I'll sit this out because there could be this over-investment. The problem is the message we just had in earnings season from all of the hyperscalers is they have too much demand, not enough supply. So that delicate mix tells you, do you want to be sitting it out? Because it feels as though you may still see extraordinary returns for at least the short term.
And that's very valid. And it's unarguable that they are still turning in very strong returns and the revenue increases as well. My point is the same. When we look at the ecosystem and the vast amount of money that's going in, not just in the United States, not just in the Middle East, but in Asia especially. I kind of almost leave Europe out of this because I just don't think we're at the front. I know there's notable exceptions like Mistral, but we're just not there. You look at the pricing and the commoditization of pricing, which is another historical fact. When you get the commoditization of pricing, prices fall aggressively. And we mentioned a story yesterday that was in the Financial Times over the weekend. Brilliant piece talking about how both OpenAI and Anthropic are cutting some of their models aggressively in price to compete with the Chinese, who are not that far behind. When you get a commoditization of product as well, then of the pricing of that product, therein lies the issue as well. So you can have these surging revenues, but if you're not making your margin on those revenues, then that's where the issue ends. And that's why we were talking a lot about 2028. Everyone's talking about 2028, where that's the level they need to get to a critical mass of revenue by.